Hello, David and I hope you are having a fantastic day.
Today, Harry and I are going to talk about why having a properly diversified portfolio is critical for long-term investing success.
We have all heard the adage, do not put all your eggs in one basket. In terms of investing, the risk of having all your eggs in one basket, so to speak, is that one investment you own tanks, for whatever reason, you risk having your life savings, your entire retirement plan destroyed. Successful investors avoid concentration risk and construct portfolios that have a wide variety of investments to help minimize their downside risk while still participating in growth opportunities. Proper diversification requires that you have a mixture of asset classes, i.e. stocks, bonds, real estate, cash, precious metals, credit, commodities, currencies, different sectors, example, technology, healthcare, energy, financials, regions, Canada, United States, Europe, Asia, emerging markets, and company size, mega cap, large cap, mid cap, and small cap.
This graphic shows the value of diversification through the financial crisis of 2008 and subsequent recovery 5 years after. Consider the performance of three hypothetical portfolios: a diversified portfolio of 70% stocks, 25% bonds, and 5% short-term investments, an all-stock portfolio, and an all-cash portfolio. As you can see in the table below, a diversified portfolio lost less than an all-stock portfolio in the downturn, and while it trailed in the subsequent recovery, it easily outpaced cash and captured much of the market's gains. A diversified approach helped to manage risk while maintaining exposure to market growth.
This chart is another good example of why diversification is critical for your portfolio construction. This chart shows how various asset classes have fared from one year to the next historically going back to 2008. As you can see, no single asset class is reliably the best performing. Canadian small cap led in 3 years out of 10, but were also the worst performing asset classes in 3 years out of 10. Sometime the best performing asset class becomes the worst the next year, and the worst becomes the best. But that's not always the case, so you can't employ a rule of thumb there. U.S. stocks were the best in 2 straight years, as were Canadian small caps. Global bonds were among the worst performing for a period of 4 to 5 years, so it's not as simple as selling the last year's biggest winners and buying the last year's biggest losers. What is interesting to note is this graph is a tight dispersion of the performance of a balanced portfolio. In no year was the balanced portfolio the best performer, but neither was it the worst performer. In every year, though, it was either medium return or higher than medium return. The balanced portfolio also delivered a much narrower range of annual returns that would have been much easier for an investor to stomach as compared to in equity categories. U.S. equities, Canadian equities, international equities, emerging markets, and U.S. Canadian small cap equities all had significant gains in one year or another, but also had significant double-digit losses in one year or another. The severe volatility of these asset classes make it hard for investors to go through the market cycle if all their money is in one particular asset class, whereas the balanced portfolio offers a much smoother and more comfortable ride.
When new clients come to see us for the first time, we often find that the biggest problem with their investments is that it lacks adequate diversification. The most common mistake we find is that most Canadians have a strong home country bias and their investments are heavily weighted to Canada. As Canada only represents about 3% of global economic productivity, you risk missing out on tremendous investment opportunities if your portfolio is overexposed to Canadian equities. The other thing to consider is that as Canadians, we all live and work in Canada. Therefore, a huge percentage of our financial success is already tied directly to the Canadian economy through the house we own or the company we work for. So why would we want to overinvest in Canada and make your investments entirely reliant on the Canadian economy too? The other common risk we see is that people over-concentrate their portfolio to a single stock, often the company that they happen to be working for. Some people receive a large portion of their compensation in stock incentives and bonuses or take advantage of company profit-sharing plans that over time concentrate a high percentage of their investments in the company's stock. When we bring this up to people, often they say things like, well, I've worked for this company for 30 years and I'm really confident that it will continue to be successful moving forward. This may be, but when your salary and your retirement savings are all tied to one entity, there is an exorbitant amount of risk associated with this. Take, for example, people who had worked for Nortel Networks their whole career. At Nortel's height, it employed 94,500 people and made up 1/3 of the total value of the Toronto Stock Exchange. In 2000, at its peak, Nortel's stock traded at $124.50 a share. And in 2009, the company filed for bankruptcy, and anyone who was unfortunate enough to still own the stock did not recoup any of their investment. Countless retirees, employees, and other investors who had a significant portion of their portfolio in Nortel stock lost everything. Having all your money in one stock can lead to good or even above average returns. But as history shows, many enormous and at one time or another successful companies have gone bankrupt or suffered significant price decline rather suddenly. A diversified portfolio of stocks will just as often lead to similarly positive results as owning a single stock, but the worst case scenario by owning a diversified portfolio is much better. Thanks again for watching today's video.
David and I are really enjoying bringing these short videos to you. If you have any questions, please don't hesitate to give David or myself a call. Thanks again.
Have a great day, guys.